First it was cars, then it was apartments, and now it's eggs. Inflation has been with us for too long, but you're finally starting to see signs of relief. Inflation is coming down, and that has big implications for you, especially if you're an investor. I'm going to speak about all of this and where to invest with our next guest this week on Global Macro Update. His name is Peter Boockvar, and he is the Chief Investment Officer at Bleakley Advisors. Hey, Peter. It's great to see you, as always. I always look forward to our conversations.
Thanks, Ed. I appreciate having me on.
You were early to the inflation call. You were one of the first analysts that I follow who said that inflation was going to go higher as a result of COVID and supply chain disruptions, and that it wasn't going to be transitory, that it was going to be with us for a while. Well, let's get an update on your thinking. Where are you at with inflation in terms of forecasts for this year and moving forward, Peter?
So it's clearly rolling over on the good side to separate out goods from services. When you look back in the 25 years before COVID, most of the inflation we had, or almost all of it, was in services. Core goods prices always averaged around zero. So depending on where food and energy played out, with zero core goods, with almost 3% services, that's how you merge it all together and got 1 to 2% type of inflation. So you had obviously the cyclical inflation. Now keep in mind, inflation on the good side is historically cyclical. Secularly, technology keeps a lid on overall inflation. So we had the cyclical spike in inflation, and not just because of the supply chains, but also because of the fiscal-driven demand side going through the roof. So now you're seeing sort of the backside of that goods price decline with overall inflation rolling over, because while services inflation is still accelerating, even in a delayed fashion, because rent growth is actually slowing and services inflation start to moderate, no doubt that inflation continues to roll over. I think the question now is, because that's just really stating the obvious at this point, is where does inflation settle out at? And I'm not talking about where does it end up on the downside, because it can end up anywhere on the downside between slowing price gains and tough comparisons. So you can even get below 2% or 1% a month here, a month there. I'm talking about after you get that decline, and where does it bounce and settle out at? Are we going back to 1 to 2% that we saw pre-COVID, or has the world changed and we're going to have to deal with a higher level of inflation than we were in the many decades pre-COVID, maybe 3 to 4%, and that's the camp I'm in, believing that some of the secular suppressants to inflation are flipping around, leading to that higher sustainable level of inflation.
So we're starting to see inflation, the rate of inflation, come down, but that doesn't mean prices are coming down. It just means they're not going up as fast. How does China play into all of this? Because, this was all happening for the most part while China was still locked down. Now China's opening back up. Last statistic I heard is that 80% plus of the entire population of China has been exposed to COVID. So that economy could come roaring back to life all at once. I would think that in and of itself could be inflationary globally. What do you think?
I'm of that belief. I'm surprised that people seem to be treating the Chinese differently than the Americans or Europeans or those in other parts of the world. That when everyone looked past COVID, there was a liberalization, so to speak, in one's economy, and everyone wanted to quickly revert back to the way they behaved before COVID. Somehow there's this belief that the Chinese are somehow scarred forever over COVID, and they're just not going to really party like the rest of us did. And I think that's wrong. I think that they've been locked up for 3 years, and if someone is let out of jail, they're going to want to live life again as they did beforehand. And one thing that the Chinese have done is save a lot of money. Now, they didn't get checks written to them like they did in the U.S., but instead they actually saved money that they earned, and savings rates are still rather high. Now, it's going to take time. It's not just going to be a one-shot deal. You're probably not going to see more of a full-fledged reopening until Q2, Q3, but that's coming. And we're talking about 17% of the world's population that has basically been locked up for 3 years. And we're talking about a $16, $17 trillion economy that has been locked up. And now, on the manufacturing production side, a lot of these facilities did not close. Now they had, rounds of sort of internal bubbles that they created, and over the past month, there's probably been disruptions because of the flare-up of COVID. But I'm talking about really unleashing the Chinese consumer who wants to travel, who feels like they've been deprived of their freedoms for 3 years, and wants to sort of regain their life again. So this is not just going to help the Chinese economy. It's going to help the entire Asian region, where every single one of these countries can call China their biggest customer. And it's going to help a lot of companies in Europe who do a lot of business with the Chinese, and some companies, of course, in the U.S. Even though the U.S. doesn't do as much business with China, there is going to be a lot of beneficiaries to this. But it's also going to mean, I believe, that commodity prices are going to inflect much higher again, particularly oil prices, and it's going to make the Fed's job and other central banks even more challenging, because while we're getting this decline in inflation trends, commodity prices, I believe, are on the cusp of going higher again, leading overall to lower but higher than we're used to type of inflation that's going to be very pesky and persistent.
Can higher interest rates really have much of an impact on inflation when you've got such a huge country driving all that demand from the other side of the world?
It's not going to be enough to lower inflation to below 2%. Even though there's a specious relationship between the Fed changing the Fed funds rate and that where inflation ends up being, but it does mean that interest rates are going to stay higher for longer, and that is an environment that will take time for us to acclimate to. And I say that because we had 15 plus years of if you go back to the early 2000s, you're talking 20 years of artificially low interest rates that just went like this in 1 year. So when you think about the drawn out consequences of that, is that every month that passes from here, every week that passes from here, every quarter that passes from here, somebody's loan is coming due that's going to need to be refinanced if it's not paid off or it's not written down, refinanced at a much higher interest rate than the borrowing rate that it was taken on at. And that's going to affect people that were borrowing at, call it 3% or less, that are going to have to refinance at, depending on your credit quality, 6, 7, 8, and into the low double digits. So that's why it's going to be what I refer to as sort of a death by 1,000 cuts environment, where more cash flow is going to have to be allocated to interest expense. And when you look at two of the main drivers of profit margin expansion when looking out at the last 15 years that brought profit margins to record highs, and not including the 2017 corporate tax cut, it was artificially low interest expense because of low rates and low labor costs. Well, labor costs are now, while they're plateauing, they're still running at about double the pace pre-COVID. And now you have higher interest expense, as I said, particularly for those who have debt coming due this year or next year or have floating rate debt. If you were fortunate enough to have access to the capital markets and termed out your debt 5 to 10 years, or if you bought a home and you have a 30-year mortgage, well, then you'll be okay. But it's those that did not hedge out floating rate exposure that's going to be more impacted by the spike in rates.
The consumer is the linchpin of the U.S. economy in many ways. And so we're very reliant on consumption. But is there a silver lining to these higher rates? Because, for the first time in over a decade, savers are actually able to earn 4% plus safely. Like, we haven't seen this in forever. There's an entire generation of young investors they've never known that you could make money just by saving your cash. It's kind of mind-blowing.
So if one's a drug addict, it is a good thing to stop being a drug addict. So it is a good thing that we have positive real interest rates, or at least no longer negative real interest rates. But going from a drug addict to being drug free, sometimes there's this withdrawal period that takes time to power through. This time, it's going to take longer to power through. It's not just a quarter here where all of a sudden higher interest rates is just fine, and that's because we still have a very low savings rate. And because we've had a low savings rate, we've been dependent on a cheap cost of capital to where borrowing created its own economic growth. Now it's going to take time to build up that savings rate that can then be used to sustain economic growth. So yes, it is a good thing to pay savers for saving. It's a good thing to pay borrowers for lending at a rate that's at least at where the inflation rate is. So yes, it's a good thing, but it takes time to work through that withdrawal period.
So there could be a little economic pain and maybe some stock market pain as that transition happens?
That is correct.
How much pressure do you think, that I'm just thinking out loud here, but how much pressure do you think that puts on the stock market? If all of a sudden the stock market has a competitor for capital, which it hasn't had for a long time?
Well, on the multiple side, it's going to compress it. We've already seen the S&P 500, to use that as an example, go from low 20s to about 17 times this year, even though 17 may be generous if you think earnings are going to be below expectations. And then on the rate side, as I mentioned, it's going to directly affect economic activity. Just housing is going to see a slower rate of transactions. And a slower rate in transactions means that there's going to be less carpet being bought and less paint being bought and less real estate brokers that are needed and less title insurance services that are going to be needed. And yeah, people are still going to buy and sell homes, but the pace of transactions are going to moderate. And autos, well, maybe people are going to hold on to their cars longer because a $50,000 car, on average, when the median income is $50,000, and now I got to pay a 7% interest rate instead of a 3% interest rate, well, I'll just keep my car for an extra year or two until I save up more money. So you still could get economic activity. It's just going to be slower than it once was.
Probably 6 weeks or so ago, maybe a little less, that I interviewed Felix Zulauf, who you know. And one of Felix's big concerns was the potential for a disappointing earnings season and the impact that could have. But how are you seeing earnings play out right now? It looks to me like sales volume is in fact going down, and companies so far have been able to make it up by pushing price. But that I worry that that's not sustainable.
So what we've seen so far, historically, companies beat about 75% of the time. So that's what's normal. That's not a good earnings season. That's a normal earnings season because of the game of lowering expectations and then beating them. This earnings season, it's actually around 70. So from that bar of 75, you're talking about a little less. And the extent of the beats are less as well. And now a lot of the earnings of relevance is to come. Most of the earnings we've seen so far are from financials, and that's sort of its own idiosyncratic sort of group where you can't necessarily extrapolate too much earnings, even though you can get obviously a sense of loan quality and demand for loans, both from the consumer level, the household level. But you take like a 3M that reported, their margins fell a bit. They talked about the challenged environment. You had Delta that talked about higher labor costs, which led them to lower their operating margin estimate to 4 to 6% from 6 to 8. So I think that overall earnings are very mediocre. And the net result is a lowered pace of earnings growth. And for the full year, I expect year-over-year earnings for 2023 to be down relative to 2022.
Does that mean you think that we're in for a recession?
I think we're basically here. The S&P Global Services and Manufacturing PMI that came out for January is in contraction for 7 straight months. So whether we're growing slightly or contracting slightly, we're really not seeing any growth. And again, if that indicator is any metric, we are in a recession. Now, GDP for the fourth quarter will probably print positive, but there's just as we saw 2 quarters in a row negative in the first 2 quarters of 2022, we've sort of reversed that in the third and fourth quarter. I think net for 2022, we're going to see very little GDP growth. Now, 2023 is more difficult to call overall because of the benefit of China. So while U.S. growth could stay sluggish, you are going to see some pickup in global activity because of China. So the net result is I'm not that sure of what that means, whether the U.S. economy will be in a recession or not. I just know that the consensus right now is a mild and shallow recession, but people need to expand their analysis of what that means past that, because mild and shallow, well, what if it's mild and shallow for 2 years, as opposed to sharp and nasty that only lasts 2 quarters and you snap back? Because a mild recession could lead to a mild recovery, or a sort of just a malaise, like we saw in Japan. And so just because something's mild, that doesn't mean that outcome is necessarily going to be any better than sharp and nasty.
How, in your opinion, Peter, does employment play into this? Because we're hearing headlines about tech companies laying off a lot of people, but outside of tech, the employment market, the labor market, has been incredibly strong. I mean, the construction jobs are the number of jobs out there in construction is higher than it was pre-COVID. It's kind of remarkable. And we have a mutual friend, Sam Rines at Corbu Research, who talks about how not only is unemployment not going down, but vacancies aren't going down either. There's just still a lot of demand for labor in the market.
I would say there's a 2-lane labor market highway here. On one lane, you have jobs where people, employers, physically need you to be on premise, on site, whether that is a hospital that needs nurses or technicians of some sort, or doctors, or it's the restaurant that needs wait staff, or needs the chef, or needs a busboy, or it's the hotel that needs cleaning people, needs front desk people. They need you
construction site.
Yeah, that's where the labor demand has been pretty strong, and wage gains have been most notable. The white collar worker, particularly in tech, where we know a lot of these companies overhired, that's where most of the job cuts are coming, in addition to parts of financial services that are related to residential real estate, and some others. Now, in the aggregate, the labor market looks pretty good, but what we are seeing, though, is a slowdown in the pace of hiring. So while companies are loath to fire, if you need people on site, particularly it was so difficult to get people, you're not going to be so quick to let them go. But what's happening is companies, in order to keep people and pay them to hold on to them, they're sacrificing profit margins. And that's what could be the fallout, is the labor market still can remain pretty good, but profit margins falter. Now, at some point, companies are going to want to try to regain their profit margins that were lost. And if the economy continues to slow, they may have less need for people. So you still have the potential for the unemployment rate to go higher from here, which I think it will. But I think overall, if we got to a 5% unemployment rate, considering the slippage in the participation rate, prior to this recession, last recessions, because the participation rate was higher, we would see a 7% unemployment rate rather than maybe a 5% that would be considered a recession this time around.
We've talked about a lot of things that I think sound pretty challenging for investors in the stock market. You're chief investment officer of Bleakley Advisors, multi-billion-dollar manager. Where are you seeing opportunity in the markets today?
So as a sort of an outgrowth of what I talked about with China, and after many years of dramatic underperformance in European and Asian markets relative to the U.S., I think the international markets are going to start to do much better on that reopening, because it's more than just reopening. It's also the very contentious relationship between the U.S. and China. And when you think about China's economy being as large as it is, and where are they going to spend their money when looking out? And I'm not just talking about the consumer, I'm talking about businesses. If you're a Chinese airline, Are you going to buy a plane from Boeing or Airbus? Probably going to buy it from Airbus. If you are a Chinese tech company and you need DRAM, are you going to buy it from Micron or are you going to buy it from Samsung? You're probably going to buy it from Samsung. Are you going to buy a wind turbine from GE? You're going to buy it from Siemens or another company in Europe. So there's a trade-off between wanting to be tough with China if you're the U.S. and what the economic consequences are for U.S. businesses when looking at over 5 to 10 years. Now, that's just one piece. I think that valuations and again, the reopening of China could lead to outperformance in overseas markets. So I think it's important to have exposure there. I think that the value versus growth trade has many years of legs to it in the U.S., value relative to growth. And I think the commodity story is going to inflect higher again on that China reopening, energy stocks, copper stocks, and what I think is going to be a weak dollar, because the strength of the dollar last year turned out to be, excuse me, just an interest rate differential thing and nothing more. And that U.S. debts and deficits, with the debt ceiling bringing it all to the forefront, in addition to the U.S. budget deficit being north of 5% of GDP, even really before the onset of a notable economic decline, I think is a secular challenge for the dollar, which could lead to outperformance in precious metals.
How about technology, Peter? Is it time to start dipping your toes back into tech? Has it been so beaten up that there's opportunity there, or would you still stay away?
Well, from being in this business for a long time, particularly in the late 90s and the aftermath in the early 2000s, I've seen what's happened to tech stocks on the upside, and I've seen what happens to them on the downside. And while many stocks have corrected a tremendous amount and may have seen the worst of their pullback, there are others that probably have not. And that a stock that's been down 50%, you can say, wow, down 50%. There are many times when I've seen it go down another 50%, and then another 50% of it like that after that. Amazon is an example from 2000 to 2002, went down more than 80%. So while many are great companies in tech land, I just think that the pendulum tends to swing in the other direction to the same extent it swung to the extreme direction on the upside, and that it's probably still premature to think that the worst is over in technology companies, stocks.
Peter Boockvar, I always appreciate your insights, always fascinating. I very much appreciate the time, and I'm sure our viewers do as well. Thanks a lot.
Thanks, Ed. Appreciate it.
Thanks for watching Global Macro Update this week. If you haven't had a chance to check out that interview I mentioned earlier with Felix Zulauf, you can access it here in the upper right corner of your screen. I'm Ed D'Agostino from Malden Economics. Catch you next week.